We start with these questions, very basic questions. We spent some good time in some introduction and basics. And we are going to calculate the same thing first, the goodwill, which we just finished discussion. It says that on 1st January 2000, always remember in consolidation, the dates are very important. So on 1st January 2000, Alpha purchased 90,000 ordinary shares, ordinary $1 shares in Beta Company for 270,000. At that date, Beta Company's retained earnings amounted to $90,000, and the fair value of Beta Company's assets at acquisition were equal to their book value, which means that market value and the book value is same. This is just to make things simple. If market value and book values are not same, then you need to make some adjustment. In this case, we don't need. 3 years later, on 31st December 2002, the statement of financial position of the two companies, Alpha and Beta, are as follows. Sundry net assets, shares in Beta, share capital, ordinary shares of $1 each, retained earnings, they have been shown. The share capital of Beta Company has remained unchanged since 1st January 2000. The fair value of the non-controlling interest at acquisition was 42,000. If you remember from our first lecture, we discussed about NCI, which is the other company, which is the other party, because Alpha Company is purchasing 90,000 ordinary shares, okay? If you see that the total number of ordinary shares in Beta Company are ordinary shares of $1, 100,000. So you are actually buying 90,000, which means 90%. So 10% is someone else, and that 10% is called non-controlling interest. And that 10% value is $42,000. And the question says, what amount should appear in the group's consolidated statement of financial position at 31st December 2002 for goodwill? Okay, now, we need to calculate goodwill. The first step in calculation of goodwill always is that first you find out that how much is the consideration transferred. And when you say consideration transferred, so who is giving consideration? The parent. Parent is giving 270,000. It is given in the question. And then there is non-controlling interest, because this 270,000 is 90%. So certainly there is 10% someone else, and that someone else, we call it non-controlling interest. For the first time, I will write down full, and later I will use the abbreviation, non-controlling interest. And the value of non-controlling interest is given in this question as 42,000. So it seems like that the total value to purchased, we call it consideration, okay? The total value which has been given to this business to acquire is 312,000 for 100% of the company. And out of this 312,000, Alpha Company is paying 90,000 and 270, other one is paying 42. Now, you don't need to see, because it might come to your mind that if 42,000 is 10%, then how come 270 is 90%? For 90%, this number should have been much more bigger. Ignore this thing, because they have got their own deal, you have got your own deal. Okay, parent has purchased under some different conditions, non-controlling interest is under different condition. So you should not be, or you can never anticipate that if 10% is 42, then 90 should be, 400K or something. Don't do that. So this is for step number one. Step number two, I need to find out net assets. And net assets of whom? Net assets of Alpha or net assets of Beta? Of course, we need net assets of Beta, because this is the company which we are buying. So what are or what were the net assets of Beta? And you should write down very clearly so that your mind becomes clear that net assets of Beta on acquisition. So I'm writing it down very specifically so that you do not get confused, because there are two dates which have been given to you. One is the date of acquisition, and one is the date of financial statements. And there is a 3-year difference. because acquisition happened on 1st January 2000, and these financial statements have been given 3 years later, 31st December 2002. So we need to find out what were the net assets. Now, net assets include share capital, share premium, retained earnings, and reserves. In some cases, you have to write down all of them. Share capital was this much, share premium was this much, and so on. But in this particular question, they made your life easy. They told you that at that date, retained earnings were 90,000. Okay. Don't take these retained earnings. They have given you retained earnings 160 also. But you will not take 160 because this 160 is after 3 years. So we will say that on that particular date, so share capital was 100K and retained earnings were 90,000. So it means that the net assets, there is no other option, share premium, etc. are not there. Only two things are given. So I can say that my net assets, and I would call it again, net assets at acquisition, very important, at acquisition. So it means that on January 1st, 2000, when this business was acquired, the business had a value, the book value was 190,000 and it was paid 312,000, which means that extra amount which was paid, that we call it goodwill. And that is the difference between this one and this one. And your answer option is 122,000, which is given down there, here, option D, 122,000. I'm sorry, not D, sorry, C, 122,000. Okay. Now, you did not notice or you did not ask me one question, which you should have asked. I took retained earnings from here. I said that I cannot take this retained earning. Why? Because this is 3 years later, right? Agreed?
Yeah.
Then why do I take share capital from here? Maybe share capital. Why do I not take share capital 3 years before? How do I know what was the share? Maybe the company has issued some share capital during these 3 years. I've said this number I cannot take because it is after 3 years, but this number I'm taking.
But it says that it is not, it has remained unchanged since January 1st.
Because of this statement. If they have not given me this sentence, probably I would be afraid of dealing with this number. I can only take 100,000 because they tell me that share capital has remained unchanged. Otherwise, I would not trust this number. Immediately, I would think, what was the share capital before? Anyways, this is goodwill. We calculated. So like I told you that we have the 6 calculations which we need to do. And one of them is always a goodwill. I'm starting with a very, very, very simple scenario of calculating goodwill. The method will remain same. What will happen that some adjustments will come in. Like when you will calculate consideration, there would be probably some other items, some deferred consideration, some contingent consideration. In net assets, maybe there would be some adjustments, but ultimately you have to find out these two numbers and make a difference. The approach will remain same. This was our question number. Let me put it down, number 26.1. If I move to question number 26.2, what do they ask me? They say that what amount should appear in the group's consolidated statement of financial position for non-controlling interest, NCI, on 31st December 22. So what was the NCI? Now, if you see that we have here NCI, I put here NCI, 42,000. But this NCI, let me make it a correct wording. This NCI, actually, we should say that NCI at acquisition, which means on the acquisition date, this is what the third party paid. Maybe you and I, we are doing together. I am parent, I am purchasing 90,000 and Joseph is giving 10%, 42,000. Together we purchased a company Beta where I paid 270, Joseph paid 42, and we acquired the business. Now it says that how much was the NCI after 3 years? After 3 years. So 3 years have passed. And then now Joseph walks in and Joseph says, Mr. Ali, I've been with you in this business, but I have different plans now. I can't continue. So you please give me my money and I will walk away. I'm not really interested because I have some other plans. So I said, Joseph, how much did you pay? And Joseph said, yeah, I remember that I paid $42,000. This is what I paid. I said, fine, if you paid $42,000, here is your 42,000 and thank you very much. Yes, Joseph, will you take 42,000? Huh? No or yes?
Yes.
Yes, you will take 42,000. I will be happy, Joseph. What else do you want? What else do you want, Joseph?
Sorry, can you repeat that question? I'm a little sick, so I'm not able to.
No, I said that Joseph and I, we acquired a business together on the date of acquisition on 1st January. I purchased 90% of the company by paying 270. Joseph paid 10% and he paid 42,000. 3 years have passed. So 3 years have passed. Here, Joseph paid 42,000.
Yeah.
And this date, Joseph says that I'm leaving. Please give me my money. I'll go away.
Yeah.
I say, Joseph, I'm giving you 42. This is what you paid. So take 42,000 and thank you very much.
Yeah.
So will you accept this 42,000?
No.
No. What else do you want?
I want the profit. I mean the excess. Because the business has grown, I want that extra.
So how much is that? So Joseph, don't forget, I have been giving you dividends throughout the year. Every year you were getting dividends. So it's not that you are getting only 42 because every year we gave dividends. Remember, I gave you 20,000 dividend one time, 15,000 one time, 15,000 one time. So I already have given you the profits. Now what do you want?
I want a share of the goodwill.
Goodwill is not there. Okay, I tell you. You will say that, Mr. Ali, I agree that you paid me dividends, but you remember we had retained earnings of 90,000. Now the retained earnings have become 160,000. Now, what is retained earning? Retained earning is called undistributed profit because every year we made $10, but we decided that we will distribute only 6, 4 you will take and 2 I will take, and $4 were added into retained earnings. We never distributed all of the profit. Some of the profit was kept in the business for the future needs. And that profit, that part of profit, which is not distributed, which is kept in the business, that is called retained earnings. So as long as I was in the business, that was fine. But now when I'm leaving, I should get my share from this profit, which was made in the past, but was undistributed. Understood?
Yeah.
So we call it here now. Question number 26.2. I am sorry, I've started from very basics and I'm explaining as if I'm explaining it from zero. I know that some of you people have knowledge about consolidation, but I don't want to, leave any brick unturned, any stone unturned. I just want to make sure that all gaps, because consolidation as we move on, it will become quite complicated. And those of you who will have knowledge gaps in the beginning, they will find it more difficult. But if you are very clear, crystal clear from the beginning, then later consolidation will look easy. So we will call it non-controlling interest at reporting date. Please pay attention to these words. Here I use the term non-controlling interest at acquisition. Here I'm saying at reporting date, which means after 3 years. So this NCI at reporting date will be equal to NCI at acquisition, which was this 42,000 plus I will add NCI's share in post-acquisition retained earning. Sometimes we call it post-acquisition change in the net assets, but here I'm keeping it simple. I'll call it retained earning. When do we say net assets? I will discuss later. So post-acquisition, NCI share in post-acquisition retained earning. Post-acquisition retained earnings are 160 minus 90, right? And you want 160 minus 90, this number, this is the change because we made the profit together, multiplied by what was your share? Your share was 10%. So you want 10% of the change in the retained earning. You say when we got the business, it had only 90,000. Together, we increased retained earning from 90 to 160. And remember, we did it together. So give me my share of 10%. So this is what you will get. And I'm sorry, Joseph, this is only 7,000. So you will get this amount, 49,000. This is what we call NCI at reporting date. More than that, I'm not going to give you anything. So this is your NCI at reporting date. Are we clear?
Yeah.
NCI at reporting date is equal to NCI at acquisition plus NCI's share in post-acquisition retained earning. Now, I just ask you one question. You and I, we worked together for 3 years. How much profit did we make together? Can you tell me? How much profit we have made together in these 3 years? Can we see from these numbers, from this balance sheet or this number? If we join this information, can we see that how much profit we made, Beta company?
70,000.
Huh?
70.
No, we cannot say. We cannot say because what we can see is retained earning, which is leftover. We know that we have leftover of 70K, but we don't know how much we gave dividends because we also gave dividends during these years. Let's suppose if I tell you that in year 1, dividend was given 20,000 to you and me together. In year 2, the dividend was given 25,000. And in year 3, the dividend again they gave as 25,000. So it means that 25 plus 20 plus 25, 70,000 we gave in dividend, plus 70,000 it has increased. So the total profit we made together is 140K. If you don't know the dividends, you cannot tell because this 160, so you only see that from 90, you increase retained earning balance to 170. But it does not show you. It does not tell you that how much was profit. So we cannot say that how much profit was made. We only know that's what is remaining balance, undistributed profit. We don't know the distributed. So we know the undistributed is 70. If we also know how much is distributed, we make a total and we can say, oh, we made this much of profit. Anyways, we are done here. Now comes 26.3. 26.3 is here. It says that what amount should appear in the group's consolidated statement of financial position at 31st December for retained earning. So here we are looking for group retained earning. How much is group retained earning? So group retained earning is very straightforward. Group retained earning. So what is included in the group? Group retained earnings. So in the group, we have got Alpha company, all of that, which is 100%, and we have got Beta company. And for Beta company, we own 90%. Okay, this is the structure of the group, Alpha and Beta. So how do we do that? So group retained earning will consist of Alpha, which is Alpha's retained earnings are 210,000. And here I would say Alpha's share in post-acquisition retained earning of Beta. See, just like here, NCI share in post-acquisition retained earning of Beta. It's the same thing. So whatever are the post-acquisition retained earnings, which are 70,000, This 70,000, like the difference between 160 and 90, this 70,000, 10% we gave to the non-controlling interest and 90% we will give it to the parent. That's how we will distribute it. So if to Rajesh, I give 10%, I will keep 90%. So that would be like this number again, but this time I will take it 90%. And I'll take it down. I'm sorry, where did I go? Control C, I'll put it here, Control V, and I'll put equals to. And the answer comes as 273,000. So this is called group retained earning. These are the typical three workings which you will get in your every question of consolidation. It is not possible that you have a group consolidated financial position and you don't do this. These three will definitely be there in every question, but of course with more adjustments. Here I just picked up with the very basic structure, but there will be more things. For example, some extra depreciation, some fair value adjustments, maybe some deferred taxes and stuff like that. So deferred tax will be involved in every time. We start with the very, very, very basic. If you have got any question, please ask me. This is very similar question to the one which we did before. 26.5, question number 26.5, it says you to calculate the goodwill. Just like we did before 26.1, it's 26.5, similar format. I'll just do it quickly. Consideration. So how much is consideration? It was by parent, and then I would say NCI at acquisition. Okay. Date. So parent hit paid. It said that Hilton Company acquired 80% of the share capital, which means parent is 80% and NCI is 20%. And to acquire 80%, Hilton paid 280,000. And then down below, by the very end, they told us that the fair value of the non-controlling interest at acquisition was 65,000. By the way, it says, now this is what I'm going to explain you a little later. Fair value of non-controlling interest. That's very important because you always need to see that if they are giving fair value NCI at 65,000, how was it measured? Because there are two different methods of measuring the NCI, and these two methods will create implications. What implications? We will discuss it little later. Right now, it is 65,000. So we know that the consideration which has been transferred is 345,000. And then we say net assets, and I will use the proper word, net assets of which company? Shrew at acquisition. It is very important to mention that this is at acquisition, and we've got share capital, which was 140,000. By the way, financial statements are for 1 year. Remember that the acquisition date is 1st January and reporting date is 31st December the same year. It means that it is beginning of the year and end of the year. So there is no 2 years or 3 years time. So post acquisition period is only 1 year. So share capital is 140,000. There is some share premium, which is 50,000. And then they show you two things. They tell you that retained earnings on 1st January were 60,000 and profit for the 2003, profit for the year is 40,000. So on 31st December, total retained earnings are 100,000. Total retained earnings, 100,000. But we are interested only in this number because we are talking about acquisition. So you will have your retained earnings here in net assets, but retained earnings at acquisition, which was only 60,000. So it means that the net assets at acquisition were 250,000. And here comes the goodwill. Very simple thing. You will take this number 345 minus 250. So you got 95,000 in goodwill. So somebody got this answer and that answer was correct. It is 95,000. This is your question number 26.5. Now, if I move on to 26.6, 26.6, it says that calculate the non-controlling interest. Again, it is a very similar question like what we did before in 26.2. So I'm going to calculate, let me put up this, copy paste this thing, NCI at reporting date. I'll take this thing so that I don't have to type it again. It is so similar that you can pick up like this, change the numbers. So what is NCI at acquisition? NCI at acquisition was 65,000. And then post-acquisition profit. How much is the post-acquisition? So if you see these numbers, this 60,000 was retained earning at the beginning of the year. End of the year, so 60 was at the beginning. End of the year, it is 100. This 40,000 is the post-acquisition profit. So within 40,000, you have to give him share. So I will say that it is, I'll just put it 40,000. And it is 20% this time because non-controlling interest is 20,000. So I'll take 20% of 40,000. And this answer is also correct. It is 73,000. I think Ronnie gave both of these answers correct. 95,000 and 73,000. Are we clear until here?
Yeah.
Okay. Now, in these questions, what we assumed, now we just learned to do 3 out of big 4, big 6. We see how goodwill is calculated, how NCI is calculated, how group retained earnings are calculated. Now, sometimes what happens that because if you pay attention to this question, what happened in first statement, they told us here that and the fair value of beta company's assets at acquisition were equal to their book values, which means that whatever non-current asset or any other asset which is given in the balance sheet, market value, fair value, and balance sheet values were same. So that was quite straightforward, simple. But sometimes there will be a difference because your book value is different than the market value. So fair value adjustment you need to make. Plus, it is also possible that when you do consolidation, what will happen? Most commonly, what will happen? This is a parent and this is a subsidiary. Now, this is what we actually discussed in first lesson as well. Subsidiary has an accounting policy of recording the PPE at cost model or any other asset at cost model, whatever. Whereas the parent is doing at revaluation model or parent is using fair value model. So if parent is using a different valuation base and subsidiary is using a different valuation base. So, and we know that consolidation, we have to prepare consolidated balance sheet with a uniform accounting policy. I cannot go and tell subsidiary that you must change your cost model. They will not. It's a separate legal entity. They have got their own accounting policy. I will tell them, you keep on doing cost model, no problem. But when I make my group accounts, in my group accounts, I will use the parent's policy. And the parent policy was fair value, or the parent policy was revaluation model. And naturally speaking, the numbers will be different. So we need to take care of that fair value differences. Like in this particular case, we said it was same, but in some cases it will be different. So let me pick up one question I need to find out from the same exercise, and we will do one question with the fair value. We got one question with fair value adjustment. Again, very simple one. 26.10. Micro company acquired 90% of the $100,000 ordinary share capital of mini company for $300,000 on 1st January 2009, when the retained earnings of mini company were 156. So their total share capital was 100,000. They purchased 90% of that and they paid 300,000. At the date of acquisition, the fair value of the plant held by mini company was 20,000 higher than its carrying amount. So now the carrying amount and the fair values, there is a difference. And we need to take care of this 20,000, how it is going to impact us. plus. The fair value of the non-controlling interest at the date of acquisition is 75,000. It seems like it is very much the same question which we have done before, and it says calculate the goodwill. Okay. Again, a very similar question, but only with one additional information about fair value. I will take this format which we made before so that we don't have to type again, and I'll put it here and I'll just change the numbers. Okay. Just change these numbers. And this question is 26.10. Now, before I do this question, let's for a minute ignore this 20,000. Let's suppose that this 20,000 is not given, and we assume that the book values and the fair values are same. So in that particular situation, parent paid consideration of 300,000. NCI at acquisition was 75,000. And I make a total of this. So total consideration paid is 375,000. Share capital was 100,000 of that company. It is given. And retained earnings were 156,000. So share premium was not there. Retained earnings were there, 156,000. So these are the only two things in net assets. They've got share capital and they've got retained earnings. So if I make a total of these things, the goodwill comes out to be 119,000. Let me write down this number. So in the absence of this fair value adjustment, goodwill comes 119,000. Now, if you want to incorporate the impact of this thing, now what is fair value adjustment? In fair value adjustment, what happens? It says that at the date of acquisition, the fair value of plant held by mini company was 20,000 higher, because it could have been 20,000 lower as well. But in this case, it is higher. And in most cases, they will say that it is higher. Impairment, they will never do it, because if it had been impairment, they already would have treated the impairment. So generally, we are speaking about higher. So it means that you have to increase 20,000 on the asset side. So when you do 20,000 on the asset side, you also need to increase 20,000 on this side. And where are you going to put it? Are you going to put it in liabilities? Of course, I will not increase my liabilities. What I'm going to increase? I'm going to increase equity section. Remember revaluation reserve? So this 20,000 will appear here on the asset side, and 20,000 will appear in the revaluation thing. And revaluation is part of equity, which means that revaluation is actually part of net assets. So what you need to do, you actually had share capital, share premium, retained earnings, and reserves. So you need to have here revaluation, okay? And that is 20,000. Now the goodwill has decreased. And by the way, we don't call it revaluation. For purpose of explanation, it is revaluation. What we need to write down, we call it fair value adjustment. So you made a fair value adjustment, and immediately your goodwill goes down. Your goodwill decreases. Goodwill goes down. Now, so it looks like that if it was not there, you would say, oh, you know what? I purchased this business and we paid 119,000 extra. We paid 119,000 more. For these assets, we paid 119,000 more. But then somebody knocks your door and say that there is a good news. You know what? They are putting something on the balance sheet for 100,000. It is not 100, it is 120. Oh, that's a good news for me. So it means that I did not pay 119 more. I only paid 99 more. So fair value adjustment, what it will do, fair value adjustment. Now, remember what happens in consolidation. As we will move forward and we start doing consolidation, we are going to use our same knowledge, which we have learned so far in different IFRS standards. The only problem is that one adjustment, it goes in many different places and it impacts many different situations. While doing consolidation, you will never see that I'm doing some trick. oh, I didn't know that. How did you come to this thing? Nothing will happen. Whether it is financial instrument, it is leases, it is whatever, PPE, you have all the knowledge because I have taught you all the standards. I always come to consolidation in the end so that you know what are the accounting treatments. So you already know. The only problem in consolidation is that one line or one adjustment impacts here, impacts here, impacts here, and impacts here. And you need to remember that this one transaction is going to impact which financial statement and where. And sometimes students, they make this thing, they do this treatment, they do this treatment, they do this treatment, and they forget to make changes in two other places. This is where you make mistake in consolidation, because you actually know, but you forget that, oh, I should have decreased it from there as well. For example, now coming back to this thing, fair value, how this fair value thing is going to impact. So this fair value, number one, it decreased the goodwill. Okay, that makes sense. Number two, your equity section should increase. That's why goodwill was decreased. Your assets in the consolidated SOFP should increase. So you will increase your assets as well. For example, if you said that parent had assets of 500K, subsidiary had assets of 600K, as a result of this adjustment, my group would be 500 plus, I'm sorry, subsidiary should not be so much big. Let's call it subsidiary had 200. 500 plus 200 plus this 20 I should add. And I would not say 700, I would say 720. So apparently it looks like, because I'm not telling subsidiary go and make fair value adjustment. They will keep on showing 20, 200K, keep on showing. But in my group, I will add them. So my statement of financial position, the consolidated one, I have to make this impact. So my assets, they go up. Goodwill, it decreases. Equity, because if I put it on my asset side, I should put it on the other side as well. So it should go somewhere else as well. And then there was one more issue. Subsidiary profit should also be adjusted, and that should be decreased. Because remember, the asset was 100K. Let's suppose that the life was 5 years. So it means that subsidiary was charging depreciation of 20,000 per year. Because subsidiary knew, or subsidiary thought, that the asset is 100K. And based on this information or knowledge, they were charging depreciation of 20K in their own income statement. But for me as a group, the asset is 120K because I'm taking in my balance sheet 20K extra. So then I would charge depreciation. According to my group knowledge, depreciation should be 120 divided by 5, which means that 24,000. So subsidiary thought that their depreciation expense is 20%, whereas in my opinion, their depreciation expense should have been 24,000. So subsidiary came in, my profit is 50. I say no. When I take it in my books, I say 50 minus 4. And this is called extra depreciation. So I need to deduct it, and I will say subsidiary adjusted profit is only 46. So you might make change in one side, but then you forget on the other side. So one transaction could be treated in 3, 4, 5 different places. And you need to understand and remember that where it is going to impact fair value adjustment, goodwill will go down, equity side increase on the consolidated assets would increase, but subsidiary profit will be adjusted. Subsidiary profit will be decreased. And by the way, when you will charge this depreciation, so I just said 500, 200, and I put all 20 of that. I should not take all 20 of that because 20 is fair value adjustment for 5 years. Out of that, 1 year depreciation has been charged. So I should take not 20, actually I should take only 16 after deducting the impact, because whatever extra asset came in, how much extra asset came in? 20. But out of this 20, this extra depreciation is 4. So it means that the impact of extra, at the closing date is only 16. If you don't understand, please ask me this 16. The fair value adjustment would become at the end, you will add 20, but then you will subtract the depreciation impact. Are we clear on this thing or not? Guys, are you lost? Am I making it more difficult?
Yes, sir.
This will come as an adjustment entry in the group books, right?
Sorry? Yeah, in the group.
In the
Individual financial statements we will not touch. Individual financial statements have been audited, signed, finished. These are group adjustments. Because you did a fair value valuation. You said that my asset, because of the assets fair value thing, we are moving it up 20K. But my point is that 20K it went up, but then there was an additional depreciation which was charged to P&L. So that impact of that depreciation, if I remove, just like my other assets, just like this 100 will come down to 80, this 120 will also come down to 96. So you see the difference is only whatever it is. 120 for how much? 24. So 96, yeah. So you need to make the difference of that. So extra will only become 16. 20 minus 4, extra will be 16. This is where you make fair value adjustment. I just explained you here. Definitely we will be doing it in every question which we will do. So you will not find any consolidation question without fair value adjustment. This is your big four. So we did goodwill, we did non-controlling interest at acquisition. We know how to find out consideration. We know what is group retained earning. And this is number 5, big 5, which I called fair value adjustment. Every balance sheet question, statement of financial position question will have this fair value adjustment. Any other thing you want to ask, please ask. Okay. I changed the screen. This is one question. I didn't pick up to Excel because I'm not going to use pen, paper, calculator, nothing. Just you guys have to give me the answer just by reading the question. Just by reading the question. No use of calculator is allowed. See the numbers and give me the answer, please. Let's do it together. It says that Breakspear company, they purchased 600,000. It's not dollars. It's 600,000 of the voting equity shares of Fleet Company when the value of NCI was 150. The following information relates to the Fleet Company data. It is 700,000 revalue. This is equity, actually, net assets, share capital, retained earnings, revaluation surplus. So this is your net assets. And then it says the goodwill arising on acquisition was 70,000. What was the consideration paid by the Breakspear company for investment? So how much is goodwill? So NCI paid 150, but how much the parent paid, we don't know. And that is what we have to calculate. We know from our knowledge that goodwill is equal to your consideration minus net assets. So goodwill, they have given us 70,000. Consideration, they have given us, they have not given us, they gave us 150,000 by the NCI plus the parent, which is X, minus the net assets are 700,000. So it means that the consideration total is equal to whatever you have paid 770,000 for this company. So if I take the number here, so it means the total amount which was paid to acquire the company was 770K. That's very simple. Like the net assets are 700 and you're paying 70 on the top. So it means that you are paying 770,000. Out of 770,000, 150 is paid by the NCI. And of course, the remaining is paid by the parent, and that makes it 620. You are absolutely right. It is 620,000. Clear? This is one more question for calculation, and which is also related to SOFP. So in SOFP, you have your receivables and you have your payables. If you remember from previous session, we said that intragroup elements are eliminated. So intragroup elements, intragroup transactions, you have to eliminate. What does that mean? It means that, let's suppose that if there are any receivables and payables, let's suppose that parent has receivable, the parent receivable was 100 and subsidiary receivable was 50, and they ask you how much is the group receivable. So you should not be totaling them. You cannot say that 100 plus 50. You need to see that how much of this receivable is intragroup. For example, if I tell you that within this subsidiary $50, $5 are owed to P because subsidiary purchased some goods from P. So within this 50, $5 is intragroup, which means that $5 S owes to P. So in that case, your total receivables would be 100 plus 50 minus 5, 145. We call it eliminating intragroup receivables and eliminating intragroup payables. Whatever are the intragroup receivables and payables balances, you have to subtract, because it is just like that I owe to myself. How can I owe to myself? Because when these were two different companies, P and S, they can say that, I sold you goods, you owe me money. They can talk to each other. But when they are within the group, they are the same, because group means that they both come under the same roof, as if it is one entity. Remember the statement, consolidate as if it is one single entity. So if it is one single entity, it cannot owe to itself. So we need to remove intragroup payments, receivables and payables. So 6 company owns 80% of the equity share capital of 7 company. Very interesting names, 6 company and 7 company. At 31st December 2004, the receivables and payables of the 2 companies were as follows. Trade receivables, 6 company 64, 7 company 39, payables 37 and 48. Okay. So 6 has receivables and payables, 7 company has receivables and payables. These figures include 30,000 that is owed by 7 company to 6 company for the purchase of goods, for which 6 company has not yet paid. These goods were sold by 6 company for a profit of 15%, and 50% of them were still held in the inventory. This is all irrelevant. We do not need this thing. So if parent is selling some goods to subsidiary, and I'm sorry, and subsidiary owes money, we don't care how much profit who is making. We only talk about the invoice value. Receivables are not impacted by this fact that these goods subsidiary sold at what price or how much profit subsidiary made. We are not really concerned. So what we need to do, you just need to add up receivables minus 30,000, because for this 30,000 is actually lying here. It is receivable of 6 company, and this 30,000 is also lying here. It is payable of 7 company. So 30,000 is shown by both of them. 6 companies putting it in their receivable. I'm sorry. And 7 companies putting it in their payables. So this is actually, this 30,000 appears in 6 company and it appears in 7 company payable. So you have to make 64 plus 39 minus 30,000. And for payables, group payables for consolidation, 37 plus 48 minus 30,000. So on both sides, we are going to eliminate these numbers. Whatever the answer is, you will pick up from here. 64 plus 39 minus 30. So 64 plus 9. So it should be 73,000 here. and 3748. So 30, 18, 18, 37, 55. So 73,053. The A is the answer. This is the answer. 73 and 55. So this is like the very basics of a few adjustments for statement of financial position. If you've got any questions, please ask me.